Hello everybody, welcome to today's fundamentals. Hello Peter.
Hello.
So we had the Fed's interest rate decision yesterday. How did that affect the markets?
Well, we had a weakening of the US dollar. Definitely the main factor behind it was the Fed's interest rate decision, but first thing first, the Fed yesterday, as was widely expected, hiked rates by 25 basis points. The decision on the rate hike as such practically cemented the downshift of the rate hiking path of the bank, and that was the first sign. In its accompanying statement, the bank also mentioned, though, that it would be proceeding with more rate hikes in the coming meetings in order to curb inflationary pressures further. And I would note that it was characteristic that Fed Chairman Powell more or less stated that the disinflationary process is just beginning. So that would be another sign that the bank is planning to keep rates high and at a prolonged period. Most probably it will be hiking rates beyond markets' expectations about a 5% threshold.
And
The third element would be Powell's press conference, though, because up until now, what we have discussed and mentioned were hawkish signals. In Powell's press conference, the Fed chairman, practically recognized that inflationary pressures have started to ease, and that was the first dovish signal. There was another interesting element where he was asked about a possible rate cut in the current year. He didn't exclude that scenario, but there is a prerequisite that inflationary pressures have to slow down considerably for the bank to start cutting rates, and that should be sustainable. So overall, and it was characteristic how the US dollar movement on a minute-by-minute basis, there was little market reaction at the time of the release of the interest rate decision, while the bearish sentiment started to build up during Powell's press conference, indicating that the Fed chairman was the main driver behind the weakness of the US dollar.
and how about the US stock markets?
Well, US stock markets rallied in the prospect that the Fed's going to be easing its tightening of its monetary policy. I would be noting, though, that there were two indexes which were clearly in the greens. That was the S&P 500 and NASDAQ. Dow Jones was a little bit peculiar in the sense that before the decision had dropped somewhat, got some substantial support at the moment of the release, and then deflated once again. So practically remained at the same levels it was before. Interestingly enough, we had yesterday Facebook's earnings report. Now there were some conflicting messages here. On the one hand, we had the earnings per share dropping, or at least not reaching the market expectations. On the flip side, though, we had the revenue figure, which surpassed considerably market expectations. And that was an optimistic sign in the sense that it seems that the advertising sector is slowly but steadily recovering, which more or less tends to push the revenue of Facebook higher. At the same time, I would be noting that the bank had proceeded with layoffs of about 11,000 persons, and that may have a lagging positive effect on the profitability at a later stage. And I would be noting that the bank is about to initiate a share buyback scheme of around $40 billion, which is also substantial and intended to provide some support for the share's price. Overall, Facebook's share rallied around 18%, if I'm correct, yesterday. And that was a very positive signal. Today, and that's the interesting element, we are going to be continuing to maintain our focus regarding US stock markets on the tech sector. We are getting the earnings releases of Amazon, Apple, and Google, Alphabet actually. especially the element about the advertising sector, which we have mentioned in Facebook early on. I think that's going to be put to the test as well. Because these companies, especially say for example Google, is also generating substantial profits from the revenues of the advertising business element.
And how about the gold prices?
Gold prices maintain the negative correlation with the US dollar, and given that the USD was on the retreat, gold prices tended to rise. Maybe not as much as we had expected, but still, it was a notable rise of gold's price. We expect exactly this negative correlation between the two trading instruments to be maintained. I would be considering the next big test for gold's price and the USD to be the earnings reports of January, the US employment report for January tomorrow in the early American session, which could create considerable volatility for the US dollar and gold's price as well, and the US stock markets.
And what's on the calendar for today?
Definitely, we highlight the monetary front. We make a start with Bank of England's interest rate decision. The bank is expected to hike rates by 50 basis points. I would be noting here that the bank may actually proceed with a 50 basis points rate hike. That's our base scenario. However, I have to note that there were a couple of analysts which mentioned also a higher rate hike is also possible. In our case, though, we still stick to the script and expect the bank to hike rates by 50 basis points. The second element is that, on the one hand, the bank has to face high inflationary pressures in the UK economy. So I would expect it to maintain a hawkish accompanying statement. On the flip side, though, the bank is expected by the market to start downshifting its rate hiking path in the next meeting, the March meeting. So that may be somewhat reflected on the accompanying statement today, as the bank may start to prepare the markets for such a downshift. Should that be the case, we may see the rate hike becoming a dovish rate hike and weakening the pound. Other than that, we expect the pound to get some support. The second element would be ECB's interest rate decision. Now, the Europeans more or less have a steady rate hiking path, a very hawkish approach. They are expected to hike rates both on a deposit rate as well as on the refinancing rate by 50 basis points. I would expect the bank, because it started hiking rates a little bit late, to maintain its hawkish tone despite the slowdown of the HICP rate for January, as was reported for the Eurozone yesterday on a year-on-year level. And I wouldn't be surprised to see it also reiterating its quantitative tightening efforts, which more or less could provide additional strain to the liquidity of the Eurozone and thus drive inflationary pressures even lower. More or less, the bank is going to be maintaining the 50 basis points rate hike as the modus vivendi, at least until the next meeting, which then we may see a downshift to 25 basis points rate hikes. For the time being, ECB is expected to remain hawkish. I would be advising caution, especially for Lagarde's press conference half an hour later, as ECB President Lagarde has a number of times reversed the market sentiment after the announcement of the interest rate decision with her press conference. So some caution would be advisable here. And I would be noting from the Czech Republic the release of CMB's interest rate decision. The bank is expected to remain on hold. I would be noting, though, that 7% is pretty high. I wouldn't be surprised to see the bank actually start shifting the tone in its accompanying statement towards a more dovish side, which could be weakening the krona. But that we will have to wait and see here. As for financial releases, we would be noting the US releases. We get the initial jobless claims figure. It's expected to rise, and if actually so, could weaken the US dollar, especially ahead of the US employment report for January tomorrow. And I would be also highlighting the factory orders growth rate. Therefore, December, a considerable acceleration is expected. Mind you that November's rate was at minus 1.8% month on month. That was a contraction of factory orders. It's expected to rise, breach the reading of 0, and come to 2.2% month on month. That's a substantial rise and could provide some support for the USD.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
Welcome to the technical analysis part of the presentation for today. My name is Peter Yosef, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour time frame. Mind you that all charts to be presented are to be of the same time frame unless otherwise stated. Now, the first observation would be about the notable drop of the US dollar index, which has dropped, breaking the 101.30 clearly, support line, now turn to resistance. Let's make the necessary corrections first before discussing the direction of the trading instrument further. Turning the 101.30 to a resistance line, given that the price action has moved considerably below it. And let's go hunting for a new ultimate support line. I would be keeping it somewhere here or somewhere here. Let's magnify it a little bit. See the touches? Yeah, 1, 2. It's a little bit wide off. We have multiple touches here as well. No, this one's better. Okay, keeping this as the ultimate support line, and that would be in green. The 95.10 support level. Locking it in. Readjusting the chart. Making a start. Give me a sec. Let's widen this a little bit even further. Let's replace all the labels. R3 now to be placed at 104.55. R2 at 103.05. R1 at 101.30, given that it has broken below it. S1 for support line now being placed at 99.55. S2 to be placed at 97.70. and the S3 at 95.10. Let me reconfirm that once again. Yep. Locking it in. Let's start discussing direction here. There is a slight downward trend line which has started to form. Seems to be guiding the pair. Let's have a look at the 1 hour chart before moving on. Yep. Yeah. On the other hand, note how, back to the 4 hour chart, note how the RSI indicator hit and actually broke for a brief while the RSI indicator at 30 dropped below it, and though recovered quite quickly. So that may imply that we are having a correction here. For the time being, and as long as the price action remains below the downward trend line, we tend to maintain our bias for the bearish outlook to be maintained. Mind you that the price action corrected high after breaking the low Bollinger Band, which more or less implied that a correction higher was imminent. So we would expect practically the downward motion to continue. In such a case, we may see the price action starting to aim, if not even breach, the 99.55. On the other hand, should the price action stabilize, the first sign to watch out for would be a breaking of the downward trend line. Yet at the same time, I would expect the price action to respect the first resistance line, the 101.30, and maintain a sideways motion around here. Very narrow, very tight range bound. But once again, we are having the US employment report for January tomorrow in the early American session and could increase volatility for the market. And I wouldn't be surprised to see the market repositioning itself ahead of the release once again. For a bullish outlook, I would expect the price action to rise, break the pre-mentioned downward trend line as expected, but at that moment I would also require a breaking of the R100 and 130 and the price action to start aiming for the 103.05. Let's have a look at Euro USD. Okay. The price action was on the rise, even breaking the 1.0935, actually breaking even above the 1.10, which was set as a resistance line as well. So practically we have a nice bullish movement which escapes the upper boundary of its past sideways movement, more or less implying that the bullish scenario is possible. Note how the RSI indicator has risen, broken above the reading of 70, also implying a rather bullish sentiment, yet corrected a little bit lower and remains just below the reading of 70. It's currently at 67.7. I would say that's still a fair assessment, but there is a downward slope, which may imply that slowly but steadily the influence of the bulls is fading away. For the time being, though, I would expect it to remain bullish. The correction lower is understandable in the European session, given that the price action was able to break above the upper Bollinger Band. So for the time being, we tend to maintain a bullish outlook for the pair. Before we move on, though, let's correct the 1.0935 and turn to support line once again. The pair has not seen such high levels since April. It's very, very interesting. And definitely we'll have to go back further to find a new ultimate resistance line. I will be placing it somewhere here on this chart. peaks. 1, 2 seems pretty valid. In red. 1.14725. Readjusting the chart. Let's correct the levels as well. The S3 now is being placed at 1.0580. The S2 at 1.0730. The S1 at 1.0935, given that the price action has broken above it. The R1 at 1.1055. The R2 at 1.1270. And the R3 at 1.1475. As we have noted, despite the correction lower, we tend to maintain the bullish outlook for the pair. And at this point, there's a nice upward movement here. And I would expect the price action to remain bullish as long as the price action remains above these upward trend line. Should the bulls maintain control, I wouldn't be surprised to see Euro USD correcting a little bit lower, maybe even testing the upward trend line, but then reverse, break the 1.1055 and start aiming for the 1.1270. ECB's interest rate decision, don't forget it, it could prove to be a high mover for the pair, depending on what the content will be of the interest rate decision as such, but also what ECB President Christine Lagarde will be saying in her press conference about half an hour later. So expect some extended volatility for Euro pairs, at least until the closing of Lagarde's press conference. Should the pair stabilize, we may see the price action remaining between the 1.1055 and the 1.0935. The first signal, which would be exactly highlighting the stabilization, would be a testing or even a breaking of the upward trend line. Yet the price action would have to respect the R1 1.1055 and the S1 1.0935. In case we have a bearish outlook, for such a scenario, I would require a breaking of the upward trend line. However, at this point, I would also be requiring a breaking of the S1 and the price action of Euro USD to start aiming for the 1.0730. Let's have a look at GBP USD. Cable. Nothing changes. You can see how cable dropped, remained relatively stable, yet the Fed's interest rate decision pushed it higher before correcting a little bit lower. It's interesting also how the price action of the RSI indicator at some point moved decisively higher than the reading of 50, yet corrected back down once again. So I would expect the sideways motion to continue between the 1.2345 and the 1.2265. As long as the price action actually respects these two levels, I would maintain my sideways bias. The catch is named Bank of England. We have Bank of England's interest rate decision. The bank is expected to hike rates by 50 basis points. depending on whether the accompanying statement will be tilting towards a hawkish or a dovish side. That could alter also cable's direction. Should BOE remain rather bullish, we may see the pair rising, breaking the 1.2345 and start aiming for the 1.2660. On the other hand, should the bears take over, in case, for example, that BOE remains rather dovish, then we may see the price action of cable dropping, breaking the 1.2265 and start aiming for the 1.20. Mind you that it's not only BOE. Tomorrow we have also the US employment report for January, which could increase volatility for the pair somewhat on tomorrow once again. Let's have a look at USDJPY. USDJPY is an interesting pair in the sense that the price action dropped, broke the 129.30 support line, now turned to resistance. We have to correct this, and seems to be stabilizing. The big question is whether the downward movement was interrupted or whether this is a brief recession. It's a brief pause before going to the downside once again. For the time being, though, I would be correcting the 129.30 and turn it from a support line to a resistance line. Let's go hunting for a new ultimate support level. I would prefer this one. Or this. Or this. I think this one's better. These throws here tend to show continuous support. It was tested multiple times, but it was also tested to the upside. I'm going for this one. And that would be in green, the 122.30, 35, sorry. Let's correct the levels as well. And the last support line being placed now at 122.35 as mentioned before. It's a little bit off, I know it, but I'm keeping it. I think that in order to get a clearer picture, we should drill into the 1 hour chart here. Yep. There's a clear breaking and stabilization. The 1 hour chart, which provides us with more detail. See how the price action dropped and stabilized, even corrected a little bit higher. And it's characteristic how the Bollinger Bands have narrowed as well. Okay. Drilling back to the 4-hour chart. The RSI indicator has dropped, almost reached the reading of 30, yet corrected higher and stabilized at 39.5. Okay, there's still a residue of bearish sentiment left here, but for the time being it seems that the price action has stabilized. I would maintain a bias for a sideways motion, but I would be highlighting that the market may start repositioning itself ahead of the release of the US employment report for January tomorrow. For the time being, should the sideways motion prevail, I would expect it to remain between the just below the 129.30 resistance line. On the other hand, should the bulls take over, I would expect the price action to rise, break the R1, and start aiming of not even testing the 130.9. A bearish scenario is also possible, given that we have a residue of bearish sentiment left according to the RSI indicator. We may see the price action reversing the correction, dropping, breaking the 127.75, a lower true than this one, and start aiming for lower grounds. Such a development would practically shift the downward trend line to the right. It would make something like this. For the time being though, we tend to maintain a bias for a sideways motion to continue. Let's have a look at USD CHF. Whoa, big drop. Okay. The 0.9145 was broken. Let's turn that into resistance line. Let's go hunting for a new ultimate support level. Here. This true here. We could move this true as well, but I would prefer this one. And even a little bit higher. Here. Multiple touches, multiple tests. Also a little test to the upside. Seems good. In green, the 0.8850. 45 maybe. That's better. 45. Yeah. Locking it in, readjusting the chart once again to make all support and resistance lines visible. Let's correct the labels. They are to be placed in the 0.945. Sorry. They are 2 at 0.9275. The S1 at the R1 at 0.9145. Sorry. The S1 at 0.9025. The S2 at 0.8925. And the S3 at 0.8845. Locking everything in. Next big question, what's the direction? Well, there are two consecutive downward motions which were intense. Let's see whether the correction higher has broken the movement. Nope, it did not. So for the time being, we tend to maintain our bearish outlook for USDCHF. And should the bears remain in charge, given that we have the RSI indicator, which is pretty low, it's actually just above the reading of 30 after correction, slight correction higher. So there's a considerable residue of bearish sentiment in the market, in which case we may see the price action once again starting to drop, bouncing on the downward trend line, starting to drop, breaking the 0.9025, and start aiming for 0.8925. For the time being, I would be keeping, and as long as the price action remains below the downward trend line, I would be keeping a bearish outlook. Yet the RSI indicator is slowly but steadily recovering and may start showing that the bearish effect is fading away. Such a development could intensify some slight bullish tendencies and stabilize the pair, probably below the 0.9145. A first signal of such a stabilization would be a breaking of the downward trend line, yet at the same time a respecting of the R1 0.9145. Should that be the case, then we would be switching our bearish outlook in favor of a sideways movement bias. For a bullish outlook, we would require a breaking of the pre-mentioned downward trend line, however also breaking a clear-cut breaking of the R1 0.9145 and the price action to start aiming for the 0.9275. That would allow us also to draw a nice upward trend line. Once again, for the time being, we maintain a bearish outlook as long as the price action remains below the downward trend line. Let's have a look at the Aussie. A very, very interesting element. The upward trend line guiding the pair remains. Note how the price action of AUD/USD jumped, broke shortly above the 0.7130 that was in the American session and late American session and Asian session. Today, yet during today's European session, it corrected lower, just below the 0.7130, yet the bullish tendencies, in our opinion, are still present. And I wouldn't be surprised to see the price action reversing, breaking the R1, and start aiming for the R2 0.7265. Should the pair stabilize, which is also an option, then I would expect the price action to correct even lower and at some point run along the upward trend line or even break it. Yet at the same time, I would expect the price action to remain between the 0.7130, providing resistance like here, and the 0.7010, providing support like here. So that would imply a movement like this. Okay. For bearish outlook, despite that being improbable, it's still possible and should be covered. For a bearish outlook, we would require a drop of AUD/USD, a breaking of the pre-mentioned upward trend line, however also a breaking of the S1, a clear-cut breaking of the S1 0.7010, and the price action to start aiming for 0.6880. Moving on to USD CAD. USD CAD, which had an interesting movement in the sense that it dropped, not much, but still, and has broken just below the 1.3285 support line and has remained there, which tends to imply that the former support line now is providing resistance. Let's correct that. It's actually providing support. Give me a sec. Let's drill to the 1 hour chart for more detail. Yeah, It's revolving around the S1. It's just above it right now. Okay. Back to the 4-hour chart. So we tend to maintain a bias for the sideways motion to continue. Note how the RSI indicator below the 4-hour chart has remained steadily below the reading of 50, but seems to have halted its drop, and that may imply that the bearish sentiment may not be as intense. For the time being, once again, we tend to maintain a bias for the sideways motion to continue. However, once again, as with all major pairs, the US employment report with its NFP figure for January tomorrow, Friday, at the early American session, could be sending shockwaves across the market. Should the bulls take over, I wouldn't be surprised to see the price action rising and aiming for the 1.3470. There is also a case to be made for a bearish outlook, and that's namely, let me show it. If you accept that there is a downward trend line, something like this, in such a case, one could argue for a bearish outlook as long as the price action remains below the downward trend line. In this case, I would expect the price action to correct a little bit higher, hit a ceiling at the downward trend line, start falling again, breaking the 1.3285 would require a lower show than this one, and start aiming for the 1.3095 slowly but steadily. Mind you that the pair has had in the past 48 hours one peak, consecutive lower peak, one throw, a consecutive lower throw. And that tends to imply that a bearish trend line is slowly but steadily building up. We're going to have to wait and see how the market actually reacts and whether the bearish trend line will be holding its ground or not. Okay, let's move to US stock markets. We're making a start with Nasdaq. Nasdaq that rallied yesterday, and note how the strengthening of the index was so intense it broke above the 12,100 and the 12,450. Both now are to be turned into support lines. And we're going to have to go hunting for new resistance levels. I would be setting this peak here, not these ones, this one. It's more consecutive, and note how there was also some support here at this point. So I think this is a more valid level. I'm keeping this as the second resistance line, and that would be in red, the 13,445, 13,145, sorry. Moving on to the next resistance line, which is going to be way higher. This peak here definitely is shouting as a resistance line. And that would be the 13,700. Oh, in red. Could that be a mid-level? Possibly yes, but I'm going all the way. Let's make the corrections on the labels as well. Turning the S3 at 11,735. the S2 at 12,120, the S1 at 12,450, the R1 at 12,825. Sorry about my coughing, but everybody here is having a cough. And the R2 at 30,145. And the R3 at 13,700. Nice round figure here. So, do we intend to maintain a bullish outlook? Yes, we do. On two elements. A, definitely the upward movement, which has created a higher peak than this one, shows us that now we have 1, 2, 3 peaks, which are consecutively higher. Also, we have 1, 2, 3 consecutive higher troughs. As long as the price action remains above the upward trend line, we tend to maintain a bullish outlook. 1. Second element. Note how the RSI indicator has risen, broken above the reading of 70. It's currently at 77, implying a strong bullish sentiment on behalf of the market. There is a catch here, and the catch is that the bullish sentiment is the one aspect. However, the other aspect is that the pair may have reached overbought levels and may be ripe for a correction lower. So it's the index, not the pair. Now, should the index correct lower, I wouldn't be surprised to see it dropping, breaking the 12,450. Probably, though, would have to make a higher trough than this one for the upward trend line to continue. So, do not be surprised to see the index correcting lower. That's part of the game. However, I would be keeping my nerves here. For stabilization, I would expect the price action to remain close but above, maybe even revolve around the 12,450 level, the S1, while a bearish scenario would have to be very intense, and in that case we may see the index dropping, breaking the S1, breaking the S2, breaking the pre-mentioned upward trend line, and start aiming for the 11,735. For the time being, once again, bullish outlook to be maintained. Let's have also a look at Dow Jones, which had a very, very different market reaction regarding the Fed's interest rate decision. You can see how the price action remained very, very stable in a sideways manner. Here you go. At some point, it tried to actually reach the 34,400 resistance line, quickly corrected lower, remained in a very stable fashion in a sideways movement, which more or less tends to imply that it may continue. On the other hand, note that the RSI indicator has risen above the reading of 50 and remained there. It's currently at 56. It's not so convincing, but still it's an indication that we may see the bulls taking over, in which case I would expect the price action to rise, break above the 34,400 and start paving the way for the 35,500. That should sum it up from all of us here at IronFX. Best wishes for solid trading.
Today, we will look at debt-based investments and their difference from stocks. While as a trader, you can trade stocks via CFDs without actually owning the underlying instrument, an investor will invest in the actual stock and own it. Most investors focus on investments that aim to increase wealth and to help them reach their financial goals like a comfortable retirement or the ability to pay for their children's education. When investors buy stocks, they purchase assets whose value is expected to increase and provide a nice return when sold. Investing in stocks also allows the owner to access a portion of the company's profits through dividends, share buybacks, or reinvestment, which helps to grow the company's and the stock's value. The stock market offers volatile returns over short periods of time, such as 5 years or less, but high returns over decades, long time periods. Debt investment can be government, corporate, and municipal bonds, as well as real estate investments, peer-to-peer lending, and personal loans such as mortgages. With a debt-based investment, you do not own an asset or a company, but instead you lend money to an individual, corporation, or government in exchange for a fixed income in return. Such investments typically offer a lower return than stocks, but are considered to be more consistent. There is some risk involved, as you might not be able to receive the funds you have loaned, and it's so important to choose your investments wisely. While they might be less risky and volatile than equity investments, they offer lower returns. The bond and mortgage market has fewer price changes than stocks. Equity investments, such as stocks, are securities that allow investors to have a claim on the earnings and assets of the corporation. Common stock trader on popular stock exchanges is the most popular equity investment. The stock market is very volatile, with rapid changes in share values. These fluctuations are usually related to political, social, or other issues in the home country of the corporation. Equity investments are famous for high risks and potentially higher rewards. It is traditionally recommended to investors that they hold both equities and debt-based investment for better diversification of their portfolio. Debt-based investments perform differently than stocks and increase during years of large stock declines. An individual's exact allocation is dependent on the investor goals, risk preferences, and investment time horizon. When it comes to trading, it is important to understand that all trading comes with risk. Depending on your trading goals, you can choose what suits you the best. You can always tailor your trading actions to match your objectives and risk tolerance. Thank you for watching.
Okay, let us begin. So yeah, welcome to another webinar series brought to you by IronFX. So today we'll be going through the Fibonacci series, 3 out of 4 on expansions. So I got to read the disclaimer first, so do bear with me. So the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. So this material is just the personal opinion of the author, which is myself, and the client's investment objectives and risk tolerance have not been considered. So IronFX is not responsible for any loss arising from any information contained. Redistribution of the material is strictly prohibited. Hey, hi there, Andrew Robinson. Okay, I was just about to start the webinar on Fibonacci series, part 3 of 4 on expansions. Okay, just a very, very quick introduction to myself. My name is Chen Yongting, and I'm actually from Everest Fortune Group. So we are actually the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a very, very special collaboration with IronFX where we are bringing you guys the good stuff. Okay, before we begin, so I'll just show you guys. So if you want to find out more of these free webinars like this in the future, you can go under ironfx.com, under IronFX School, under webinars. So you can click on it, and then I'll send a link to the chat also. So that's where you can sign up for future webinars like this. Okay, where's it? Webinars? Okay, where's that link? Okay, I think I have an ad blocker in place. Okay, it's right here. At the bottom. Okay, I just saw it disappeared again. All right, here. Okay, so yeah, right there, Fibonacci series, 3 out of 4 expansions. Next, we actually have Jindal and Sarah, which is tomorrow. Okay, there's also the IronFX YouTube channel. You can actually watch replays on the past live that we have actually went through. So I'll send the link to the YouTube channel. You guys can check it out there. And last but not least, if you want to contact me outside of this webinar, you can actually contact me through this link right here. I just send the link to the chat already. It's a Linktree link about myself. Is basically a portfolio of myself, LinkedIn profile, and everything else about me. So feel free to check it out. Follow me there if you're interested. Ask me any questions that you want outside of this webinar. All right, let us begin. Okay, so a few topics to cover today. Few agendas, a recap on Fibonacci retracement essentials, ideal market structure, significant swings, and following the market trend. We also have the different Fib retracement levels and what are Fibonacci expansions, which is the main highlights of this webinar, and going through confluence levels. So let us begin. So Fibonacci retracement checklist, just a very, very quick look at this. The market structure, is it clear or not? Look for big zigzags. So actually you notice that the market is moving very, very closely along the Fibonacci trend line. So you can actually see this nice little blue line right there going through the charts. Let me clear this out. So it's actually a very, very clear structure, very, very clear downtrend, bearish market. So identify the recent trend, prices going up or down. In this scenario, it's going down. So you connect the two extreme points, drawing from the top of the swing high, which is the starting point, to the bottom of the swing low. So this is how you draw a Fibonacci retracement. Okay, looking at this, insignificant swings. Recap. You are not going to care about all these tiny, tiny movements on the chart. Take a look. So look at this GIF, is actually drawing out all the insignificant swings or using the orange highlighter. It's too insignificant, so you cannot just draw randomly, you know, from this tiny little swing up to this high right there. It's not significant enough. You need to be drawing from this significant swing low right there to this highest point somewhere there. So you draw the Fibonacci, it should look something like this. That is a proper significant swing. So if you want, I can actually show an example on the chart. Maybe there's an example. Okay, insignificant swing showed you already. This is too insignificant. All these kind of swings right here, too insignificant to even draw out. Okay, let me see. So this is actually a very, very nice significant swing move right there. Can see? From a swing high, drawing towards a swing low. So it's actually a significant move up with obvious, clear market movements. Okay, let me check the previous slide first. Did I miss out anything? Okay. Next, drawing a significant swing. So here's another example of significant swings. So I've actually drawn out the peaks and troughs to point out exactly how clear it should be. So this could be a significant, where is it? Significant swing points towards the downside. So you should only be focusing on this. This is just minor swings, which is insignificant. Focus on this that I've circled out, drawing the Fibonacci from the top to the bottom. So it's a very, very clear-cut swing right there. Okay, next, let me move on. So next, following the market structure. So the Fibonacci retracement, here's an example of how to not draw a Fib retracement trend line. Your Fibonacci trend line must follow price structure clearly. Hello there, Olivia. Olivia Ponche. What time frame do you use? Well, time frame doesn't matter. Even on 1 minute, you have to find something that is significant. It even works on the 1 hour time frame, 4 hour time frame, 15 minutes time frame. So I'll show you. Since you're asking that, I'll show you an example. Okay. Let's move on to the live chart first. So let's start from the daily. The daily chart. So if you want to draw a Fibonacci trend line from the daily chart, you should be drawing from this significant swing high right there to the next significant swing low right there. So in order to use the Fibonacci trend line, the tool is right here on the left side of trading view. You should be going right here. Trend line 1, 2, 3, you expand it out. It should be called the Fib retracement tool. So you draw it from the top of the swing high, draw it to the bottom. You notice that it's very, very nice. There's a very, very significant swing. So clearly, price is currently trying to reach towards the 50% Fibonacci retracement line. So it's right here at the 50%. We can possibly see, so for example, right here, euro dollar to likely head towards the 1.09440 level, which is also the Fibonacci 50% retracement. Okay, let's move on down towards the daily, towards the 4 hour chart to draw another one. So let's move down to the 4 hours. So we are looking at a significant swings. So this could be a very, very significant swing. So a swing right here towards a significant swing towards the downside. So you can actually draw a Fibonacci line from the bottom towards the top. You actually notice that price actually retraced back down towards the 61.8% before it continued pushing bullish. So another point you can draw out is, since that point swung up, this was a significant swing, and then this was a significant swing high. Same thing, you draw a Fibonacci line from the bottom to the top. It's following very, very closely, very, very nice. And then it swung down. Where did it retrace towards? That's the question. It retraced towards the 61.8% Fibonacci line before pushing higher. All right. So let me find a clear-cut one. So there isn't anything clear at the moment that we can actually draw out. Okay, let's move down. Okay, before I move on, this could also be another significant swing. Look at this very, very obvious swing towards the downside. You can start to draw a Fibonacci line. Drawing from the top to the bottom, and you notice that price also retraced back up towards the 61.8% Fibonacci line before rejecting back down. So that's a very, very nice way to draw your Fib levels. So next, let me show one last example before we move on towards the 1 hour chart. It's actually the same on all time frames. So this is a significant high, significant low. Can draw price actually retrace all the way up towards the 61.8% before rejecting towards the downside. So time frame doesn't matter as long as you know how to draw your chart properly. Everything works well. Hey, hi there, Xion Onyen Ni. Hi there. Let's move on towards the 1 hour chart. Okay. So by the way, those who have just joined, I've actually turned on the chat already. So you can ask me any questions there within the chat. You can talk to me there. Ask me any questions while moving on. If you do not understand, feel free to ask any questions. Do not feel that you are slowing down the entire webinar. If you do not understand, that's what we are here to. We are here to learn. So looking at this 1 hour chart, this could be a significant swing high. This was a swing high. It went all the way back down, a significant swing low. It retraced back towards the 61.8% Fibonacci line. So it went down, tapped, and rejected towards the downside. Okay, next. This was also a very, very obvious. You only would be drawing Fibonacci line at the very obvious points. Significant swings. So you draw a Fibonacci line from the top towards the bottom. Price actually retraced from the bottom towards the 61.8% Fibonacci line before, it kind of short sellers try to take over, but the buyers took hold. So likely we can see euro dollar continue moving to the upside. Okay, so just move on 30 minutes. I'll just continue making it faster and faster. So this is actually quite a significant swing also. Significant swing, it actually swung up, hit back down, and retrace back up. So you can draw a Fibonacci line from the bottom towards the top. It likely retraced towards the 23.6% Fibonacci line. You can see right there. Very, very clear cut. Price very, very nicely moving. Hit back down, retrace, and short right up. Hey, hi there, Rajesh Rama. And hi there, Tivin Campbell. Okay, Juha, you actually want to see Brent's oil retracement. Well, let's go towards that. So if you are watching on your computer, feel free to open TradingView. Let's practice this together. Hopefully we can improve our trading together. Okay, let me turn on crude oil. All right, crude oil, Brent crude oil. Okay, looking at this, okay, maybe I should move towards the 1 hour chart. It's a very, very obvious significant swing high right there that we are looking at before price swung all the way down. So we can actually draw a Fibonacci line from the top to the bottom, and you notice that price likely just tapped very, very nicely within the 50% Fibonacci line before it rejected towards the downside. So yeah, these very, very clear cuts, very, very obvious, and it's extremely clean. You notice it's very, very close to with the Fibonacci trend line, bearish trend line. So next, another one I would like to show you. Looking at this specific scenario, very, very obvious swing, very, very obvious swing low. You can draw a Fibonacci line from the top to the bottom. Price actually retraced back up to the 78.6% Fibonacci line. So it's quite a high retracement. Price followed very, very nicely before it retraced back up and shot towards the downside. Okay, let's move on back to the chart, to the PowerPoint presentation. Okay, so let's go through this one more time. Fibonacci lines, retracement lines should not cut through two large areas of the market structure. So in this specific scenario, this actually cut through the trend line. It's not valid anymore. It's not clear. It should be following the market structure very, very cleanly. So when you're drawing a trend line, you should follow the price of movement and not deviate too much. Any questions so far? Feel free to let me know in the chat. Okay, let's move on. Okay, as I mentioned just now, through that practice that we had, price is following very, very nicely with the market structure. So you saw it's following very, very nicely. That's how you should be drawing a Fibonacci retracement trend line. So it works well when it follows price movements, and Fibonacci lines actually work better on higher time frame. Why? It's because it's due to less noise. Less noise as in less deviation away. So price does not move away too much from the Fibonacci trend line. Okay, next, let's move on. Okay, clear market structure. This is actually very, very clear cut. These are very, very nice a very, very nice market structure. So although a fib retracement can also be used in both choppy and trending markets. So it's important to look for clear market structure. So in this case right here, clear swing high, swing low, clear swing high, and a clear swing low. Then clear swing high again, clear swing low, and another clear swing high. So if you want to screenshot this, please screenshot this now before we continue. You can whip out your phone, take photo before we continue. Okay, next. This is a very, very unclear market structure that we do not like at all. Okay, so you see, price does not, where is it? Price, there's no significant swings at all. Price is very, very choppy and it suddenly moves up. Even the downward, it deviates. Let me clear everything. Even if you try to draw a Fibonacci line from the top of this swing high towards the swing low, is totally wrong. It's because price, this area deviates quite far away from the trend line. Same thing if you draw from the bottom to the top, the bottom right here to the top, if you actually draw a line across, it's not that clear because price went up and it's this area, it actually retraced too much. So it deviates quite far away. What you want is for the trend line and price to be relatively close with it. Okay, let us move on. So there are actually fib numbers that we typically use in trading. You can actually take a screenshot now if you want. Please screenshot this down. It's very, very important. Screenshot this down and please apply it. Please try to apply Fibonacci trend lines when you are trading. So now that we know how to draw the fib retracement trend line, let's look at the different types of levels ranging from negative to above 100%. So although the tool used is Fibonacci retracement, it can lead to 3 types of Fibonacci expansions, those below 0%, which is the Fibonacci expansions right here, negative 61.8% and negative 27.2%. You will only be using these two. So retracements, those from 0 to 100%, which is the regular ones. Right here, regular ones, 0 to 100%, and extensions, Fibonacci extensions for those above 100%, which is the 127.2% and the 161.8% Fibonacci extension. So we will go through expansion and extensions more in depth in the coming webinars. So in this webinar, we will just briefly introduce the levels. So I'll give you guys one last chance to actually screenshot this down, take a photo before we continue. All right. Okay, let us move on. Okay, here you can see all the different fib numbers that we mentioned in the previous slide and how it looks drawn out. So take a note of the starting and ending points. So we started drawing from here and ended drawing here. So take note of the starting and ending points of our Fibonacci trend line, the mid-range retracements, negative expansions. So the negative Fibonacci expansions are right here. And the above 100, the positive Fibonacci retracements. So in all of these 3 Fibonacci scenarios, we are only using one tool at the end of the day, which is the Fibonacci retracement. All right, let's move on. Okay, today we'll just be focusing on the negative Fibonacci expansion. So using the Fibonacci retracement tool, we make use of the negative levels, namely the negative 61.8% and negative 27.2% Fibonacci levels. So when using the tool, look out for flash, zigzag, or lightning symbol. So ideally, price should retrace at least 50% in 0.3 as shown in the video right here before reversing off. So take a look, draw from starting to ending, retrace at least 50%. Before you notice, price actually rejected off the negative 27.2% Fibonacci line. Okay, take a look. It looks like zigzag, like a Harry Potter zigzag line. So the explanation, the clearer the movement of the flash zigzag, the better. We ideally need to wait for prices to retrace at least 50% in 0.3 before taking off in the other direction. Okay, so maybe I'll just watch through it one more time. It actually rejected right here, rejected back down towards the downside. Okay, next, Fibonacci expansion. Okay, let me see. So here is an example of expansion and how it plays out. So starting and ending points, take note of it. Starting right here, ending point right there. Price actually retraced back up to the 61.8% level. So we show how to make use of the support in the negatives. So potentially we want to look out for flash zigzag, potentially look for price to retrace back up before heading downwards towards the negative 27.2% Fibonacci retracement line. We take a look, price actually retraced back down towards the negative 27.2%. Okay. Okay. Bounce back up. So take a look, price when it touches very, very nicely within the negative 27.2%, price usually comes back to the ending point. So yeah, please screenshot this down before we continue. Please screenshot this down, just showing examples of how it works. Okay. Next, let us move on. Take a look. Even at the negative 61.8%, price actually tapping ultimately into that. You are drawing from the starting point to the end point, price went up, retraced back down, and went back up towards the negative 61.8% retracements before, heading back down towards the end points, which is right here. So yeah, you can actually use the negative expansions, negative 61.8% and negative 27.2% as a potential take profit target. So once price steps into that level, you can look to actually close out your trade already, just in case price reverses back down like in this scenario. So let us continue. Okay, so take note of the shape of the flash. Make sure price reverses to at least 50% before breaking the starting point. So we draw it from the starting point towards the end points right there. So price retraces back at least 50%. So from bottom to the top, at least 50%. And then it hits down towards the negative 27.2% Fibonacci expansion level. So notice price steps into that and immediately bounces right back up. So please screenshot this down also before we continue. This is the example number 3. Right, give it a moment. Okay, let us continue. Okay, so next, looking at, okay, in this GIF, right here. So take note of the shape outlined by the orange arrow. So price retraces more than 50% of the Fibonacci trend line. So in this case, more than 100% and reverses nicely off the 27.2% Fibonacci expansion. So take a look, price retraces back down. So maybe we can start doing some, some kind of practice session, intense practice session. So let's find an example. Okay, if you notice right here, I'll be drawing a Fibonacci line from this significance swing high towards the significance swing low. Hey, hi there, Samuel Julian. Nice to see you. So we'll be drawing the Fib from the top towards the bottom. So just now, as I mentioned, price retraced back up towards the 78, at least 50%, 78.6. So we can actually start to see price possibly heading towards the expansion level, negative 27.2%. So you'll notice price actually tapped very, very closely, went down, tapped pretty closely towards the negative 27.2% before it retraces back up. So yeah, this is one example on the live charts. So maybe we can start to look for more. Okay, let me find another one. Maybe likely, possibly looking at the euro dollar. This is a currency pair that I like to look at a lot. Okay. Let me find it on the 1 hour. Okay, let me find a clear one instead. Okay, maybe let's take a look at this. I'll test it out. Okay, didn't bounce, didn't retrace, not good enough. Let me find this. Okay, this is a pretty nice one. If you take a look, instead of 78.6, let me find 50%. So notice, I will be drawing a Fibonacci line from the bottom of the swing low towards the swing high, and then price went up, retraced back down towards the 50% Fibonacci line before pushing up relatively close towards the negative 27.2% level before it actually retraced back down. So just take note, that's how you actually use the Fibonacci expansion levels. So let us find another example, another nice example. Okay, let me find it. Okay, trying to find a clean one, at least 50%. All right, so likely this scenario, so let me test it out. It wasn't close. This is not the greatest example because I'll be drawing from the swing high towards the swing low. Price actually retraced back up towards the 50% Fibonacci line before heading relatively close, not close enough, towards the negative 27.2% before it just shot right up. So let me find another example. We'll be just doing practice sessions like this. Okay. Okay, this is quite nice. Okay, let me draw. Is it good enough? Okay, it's actually not good enough. Why is this not valid? This is not a nice Fibonacci line because price actually deviated quite far away from this trend line right there. So this is not a good example. So let us move on. Let me find another one which is nice. All right. Clean one, trying to find a clean one. Likely this could be possible. Okay, this is actually quite nice. So notice that price swung from this swing high towards this low, and it retraced back up towards the 50% Fibonacci line right there before it shot down towards the, I think it did hit the negative 27, negative 61.8%. So it actually didn't, it went towards the negative 27.2% Fibonacci expansion line before it kind of consolidated before shooting back up. So yeah, always just try to look at the negative 27.2% as a potential take profit target. Okay, let's find another one. Find another significant swing. So yeah, this is actually quite a nice one. So you notice that we have a pretty much a significant swing right there. So I'll be drawing a Fibonacci line from the bottom to the top. You notice that price actually retraced down to at least the, let me draw it out, at least the 50% Fibonacci line. Price went up, relatively nice, went back down, retested, went back up, relatively close towards the negative 27.2% Fibonacci line before it rejected back down. So relatively close, pretty close, you can start to close out your trade already. So if you're actually aiming for exactly negative 27.2%, you might actually miss your close and not hit take profit. Okay, next. Let's find another example right there. 50%, there isn't anything nice. So maybe I'll move on towards the H4 chart so I can view things clearly. All right. Okay, maybe this right here. It is not clean enough. If I actually draw a trend line, I was looking at this area, wanted to draw a trend line right there. But what happened? It wasn't clear cut enough. It's pretty clear. All of a sudden, it deviates quite far away and it shot right back up. So this area actually caused me to not want to view this Fibonacci trend line as a valid one. Okay, let's find another one to practice. Okay, this is pretty nice. This is quite nice, drawing from this significant swing high right there. Okay, this is not significant enough. Let me find another one. This clear cut enough. I think I might be looking at one. So this is quite a nice swing high. Okay, but it did not retrace to 50%. Okay, maybe it did. Okay, here is quite nice. So you take a look at the H4 chart. So from this significant swing high towards this significant swing low, price is moving very, very closely along the trend line, tap right into it, shot right back up, retrace towards the 50% Fibonacci line before heading down towards the negative 27.2% Fibonacci expansion line. So what happens after price steps into that? As we have done many back tests, price actually consolidated a bit before rejecting back up towards the starting points of this trend line, of the end points. So if you actually draw a box over, this is where we draw the fib. All right, any questions so far? Do let me know in the chat, since we are here to learn. Anything you guys do not understand, just ask me. I'll try my best to answer you. Okay, let me check if this is significant enough. Okay, this is actually not bad. So drawing from a significant swing high towards the significant swing low, price is very, very nicely along this trend line, went back up, retested the 50% Fibonacci line before it shot right down towards the negative 27.2 Fibonacci retracement line. So just now, as I mentioned, price usually hits back up to retest the endpoint, the previous swing low. So I'll just draw a box out, an extended box, maybe an extended box red. You notice that price actually more or less hits back up towards that area. So it taps into also the negative 61.8% before it rejected, and relatively near towards the starting point, the end points of the Fibonacci line, and then just continued heading back. So what do we call an area like this? We can call it an overlap resistance. So I'll just type it out in case you don't know how to spell it or don't know what I'm talking about. It's the overlap resistance. So inside center break. All right. So yeah, if you want, please screenshot this down before we continue. Okay, I'll just screenshot this down and send it to the chat. Copy link to chart image, send it. All right, I've just sent the link to the chat. You guys can actually check it out right there. So it's actually quite clear cut on that. We can actually move on. Okay, next. Let me move back towards the slide that we are going through. Okay, this not okay. Invalid Fibonacci. When does a Fib retracement becomes invalid? So one of the most common scenarios is when price makes a lower low. Assuming you are drawing a Fibonacci retracement from the top to the bottom, like in the picture. Okay, never mind, like in the picture. So if there are bars on the right that breaks your ending point, it becomes invalid. Just like I mentioned, it deviates quite far away, invalid. There are Fibonacci retracements that are negative 27.2%, negative 61.8%, and we will touch on them as they basically go through your endpoint, yet they are still valid. So take a look. Price breaks the points. We want to draw from the top towards the bottom, but price didn't retrace back up to 50% level, at least 50%, and it continues going down. So this kind of no longer valid already. Always look for at least 50% retracement. Okay, next we are going through combining Fibonacci levels. So it's for confluence to our trade. Okay, give me a moment. Okay, the trick is to find multiple Fibonacci retracement levels lining up together so that you can increase the probability of a bunch of Fibonacci retracement levels working versus a single Fibonacci retracement level working. So this is the definition of a Fibonacci confluence. So I'm just showing a very, very quick example. The negative 27.2% Fibonacci expansion is in line with the 161.8% Fibonacci extension, in line with the 78.6% Fibonacci projection. So many confluence of these levels, and then price just bounce right back up. So maybe I can show an example on the live chart. So let's take a look. I'll try to find one which is nice. So maybe why price bounce right off that area. Likely we can try to see something. Okay, that negative 61.8 and an expansion. Okay, there isn't a level right there. So I'm trying to find a nice level, a projection level. Okay, we don't have it right there. We don't have it. Not clear cut enough. Expansion drawing up. Okay, maybe we might have something right here. Okay, there's nothing right here. No confluence levels yet. Drawing a fib. No confluence yet. Okay, let me find one. I've got to find an example for you guys so you guys can understand. Wait. Maybe this level. Okay, maybe this nice level right here. So can draw a Fibonacci line. This is quite a nice tick. Okay. So we actually have a nice Fibonacci. We can draw a projection from the top to the bottom and then towards the top again. Likely we might be able to find some kind of confluence right there. Okay, this is very, very weird. Let me move on towards the 1 hour. Try to find one that is significant enough for that bounce. Projection levels. Okay, this could be it. Try from the bottom, top, up. So with the 100%, I'm actually looking at this area right here, checking whether there was any Fibonacci confluence that caused price to retrace back down. Drawing a fib towards the bottom. Okay, there isn't any. Okay, that's weird. Let me just give me a moment. I'm still finding. Okay, this is not D1. Projection, top, bottom, and backup. 78.6%. Draw fib. Okay, this is actually quite nice. Quite a nice retracement area. I'll draw the 138. So you actually notice that price actually. Wait, give me a moment. Let me clear this out. Trying to stick everything clearly in place. Just to show you guys how it works. So Fibonacci line, then we also have another line or fibs. Okay, this is not the confluence. If you actually draw, notice that price actually tapped very, very nicely in the 127.2% Fibonacci extension level. So I'll just extended box green. So with that two confluence in place, 127.2% Fibonacci extension. Extension is the positive side. Expansion is the negative side. So we also have the 78.6% Fibonacci projection. So that's how we use it. You can possibly look for a buy entry right there for price to tap and rebound towards the upside. All right. Let us take a look next. Let's find another confluence. Okay. Okay, let me find. Okay. Potentially this might be it. Let me find. All fibs. Okay, negative 61.8%. Showing a Fibonacci expansion, top to bottom. Okay, this is actually quite nice. If you actually take a look, the negative, the 78.6% projection and the 161.8% Fibonacci projection. Take a look. So I draw a projection from here. Bam, bam, bam. That's how I draw a projection. Getting the 78.6% Fibonacci projection. We also draw a Fibonacci line from the top to the bottom. We have the, so over here is the 78.6% Fibonacci projection. We also have the 161.8% Fibonacci extension. So these two right there actually added confluence to why price actually rejected back down. So price tapped into that level and rejected strongly towards the downside. So I'll just draw that level out. It's quite clear cut right there. Went up, tap, rejected back down. Where does it reverse towards? It actually reverses towards the more or less the starting points of this Fibonacci high, the previous high right there. So you can call it a support, an overlap support if you want, extended box green. So this could be a nice sell entry that you could have caught right there. So I'll just copy link to the chart image. I'll just screenshot and just send it to you guys. I'll just send the link to the chat already. So any more questions, let me know. Any more questions that you do not understand on Fibonacci confluence, let me know. So let us continue and end this slide. So this another example, negative 27.2% expansion. Just showing examples. I don't expect you guys to, at the end of this session to be able to immediately implement it. You might want to go through some practice drawing on your trading view chart before you start to look for potential buy entries, reversal entries. Okay, let me find what else is needed. All right, for this example, price broke through the negative 127.2% and the negative 27.2%. And then price went towards the negative 61.8% Fibonacci expansion and towards the 161.8% Fibonacci extension. Price then tapped and reversed back down. So that area actually gives us a pretty strong confluence area that price can possibly reverse. Okay, same thing. Drawing down negative 27.2%, 127.2%, and even a 100% Fibonacci projection. So this entire area right here actually added confluence that price could potentially reverse and point back up. So price then proceeded to bounce off this very, very strong level. There's many confluence. Hey, hi there, Steffi, tap in. Okay, let me go through this. So stop loss beyond, what does it mean? It means that you should always put your stop loss beyond a key Fibonacci confluence area. So the reason for this is because more often than not, price is attracted to such strong areas of Fibonacci confluence, and if your stop loss is right before instead of beyond the area, Fibonacci confluence area, you can potentially hit your stop loss, get stopped right up when the market starts to reverse. And then traders start to complain about getting stop hunted, saying the brokers manipulated the market. It's actually not. It's actually there was confluence. There was a confluence, caused price to tap in before reversing back up. So take profit before. What does it mean? It means that you should always put your take profit target before a key Fibonacci confluence area. The reason for this is because when price reaches the Fibonacci confluence area, the reason for this is because when price reaches the Fibonacci confluence area, there's a high chance that it will not be able to go beyond it, and instead of reaching your profit target, it reverses back to your entry. So always put your take profit target just before the Fibonacci confluence area. Just slightly before, 1 or 2 pips before would be nice. So this is one of the reasons why people complain that the market is manipulated, because they miss their take profit target by 1 pip. So yeah, you can actually screenshot this down before we continue. All right. So once you guys have screenshotted it down, take photo down, let's move on. So we have come to the end of this webinar. So yeah, really thank you guys for joining. If you guys have any more questions, let me know. I'll give you guys 1 more minute. 1 more minute to ask me any more questions before I end this webinar. So until my time, 6:53, I'll be waiting for your questions. So meanwhile, while waiting for your questions, I would like to say that tonight, okay, for my time, it's tonight. It will be when I'm sleeping. It will be 2 a.m. for me when the FOMC news actually happens. So yeah, just take care trading. Please try not to enter any scalps just before the FOMC news. You can potentially get stopped out. And also Friday, we have the NFP. The entire week is really, very volatile. Hey, no problem, Juha. Hey, see you next time. See you guys next time. Appreciate you guys for joining. All right. So let me just send that link one last time. Link 3. That's the link you guys can actually find me, can actually contact me there if you want after the webinar. So yeah, thank you, Juha. Thank you, Peter, Benny Brook. Thank you, Samuel, Julian, for joining. Hope to see you guys next time and really take care. Stay safe trading. Hey, goodbye, guys. I'll be ending the stream now.